Hello, welcome to a transfer pricing masterclass. Today we are going to focus on transfer pricing fundamental and dive down into detail, and it's more of a technical discussion on the 5 economically relevant characteristics. Today we're going to understand why these are important, what they are, why are they now hard-coded in the Canadian legislation. And also we're going to focus on some recent jurisprudence, other landmark cases where the 5 economic characteristics really played a pivotal role. The objective of this presentation is to really help you understand how vital these 5 characteristics are to apply them into your transfer pricing practice. My name is Dean Morris, founder of TP Compass and collaborative member of Fairware AI. TP Compass is a full-service transfer pricing boutique that specializes for small and mid-market multinationals. Fairware AI develops web apps and automations using recent technology to apply both for our own clients, and we also serve large multinationals, helping them implement AI technology in a safe, secure environment that is tested and verified to make sure that the tools and web apps are very effective and for their needs. Akhil, why don't you introduce yourself?
Hi, Dean. Hi, everyone. My name is Akhil. I'm a transfer pricing consultant with TP Compass. I've worked on transfer pricing reports and transfer pricing analysis, business side interpretations, and so on. So my role today is basically to take some of those concepts, which can sometimes feel a bit technical, but I make sure break them into something simple and practical. So let's start about transfer pricing. What transfer pricing actually is. So the simple and helpful way, what I think to explain transfer pricing is through a simple analogy. To considering it with an iceberg or thinking about it as an iceberg. So the top of the iceberg is actually what you see. It's the financial outcomes or the reports, the margins, the price, the profitability. That's all what you see through with the report. Everyone looks at it. That's what the tip is. But there are numbers that typically show up in the report, benchmarking studies and financial statements. But what much important is when you look at an iceberg, it won't be as if an iceberg should be strong at the tip, it should have a strong foundation below that. It should be really deep. That foundation in transfer pricing, we call it as the 5 economically relevant characteristics or the 5 comparability factors. So these 5 comparability factors are the major topic of discussion for us today, and it is a solid if the base of an iceberg is solid, the price what we call for a transfer pricing report won't collapse under an audit. So if you only focus on the numbers without understanding what drives them, you're essentially missing out the most of the analysis part, I would say. And that's one of the most common mistakes when we do a transfer pricing. Dean, you want to take us through the 5 comparability factors?
Yeah, and before I do that, I just want to say, where do these 5 factors come from, or where do they fit in with the OECD Transfer Pricing Guidelines and basically the overall, the OECD organization. And to start, I'm going to focus on the authoritative statement of the arm's length principle. Now, this is a print statement that is mentioned, probably thousands and thousands of times, and it's found in paragraph 1, Article 9 of the OECD Model Tax Convention. And I'm going to read it out, but there's a lot there, so we're just going to unpack it. Where conditions are made or imposed between the 2 associated enterprises in their commercial or financial relations, which differ from those which would be made between independent enterprises, then any profits which would, but for those conditions, have accrued to one of the enterprises, but by reason of those conditions have not so accrued, may be included in the profits of that enterprise and taxed accordingly. So there's a lot in that authoritative statement. And today I'm just going to break it down into 2 main concepts. The one main concept is that we view the legal entities in the multinational as separate entities. And the second one is really focusing on the conditions, the transaction conditions. And when we focus on the conditions, you're saying, well, how do these conditions differ if it's a controlled transaction or an uncontrolled transactions? And when we examine those differences, that's where we get to the comparability analysis. And the comparability analysis, it's referred to in the OECD guidelines as the heart of the arm's length principle. And within this heart of the arm's length principle, these are where the 5 economically relevant characteristics are detailed. So that's kind of the overall context of where these characteristics fit in. So when we do this comparability analysis, which is really the heart of what we do, these are the characteristics, the traits, the context that we have to gather in order to do the comparability analysis, in order to implement the arm's length principle as associated with this authoritative statement. So those 5 characteristics, the number 1 is your written contracts, is the contractual terms. Going back to Akhil's analogy of the iceberg, it's almost like the top of the iceberg. What is each of the entities doing? What's their role? What's the price in a contract? What are they contributing, and how do they get compensated for that? And the other elements is kind of, you think of almost underneath that, saying it's kind of supporting the terms and conditions that have been established. What is the entities actually doing for the functions? What risks are they taking? What key activities are they providing? What's the nature of the characteristics of the product? That's the third one. The fourth one is the economic circumstances. And then the fifth one is business strategies.
Yeah, so each one actually plays they play different roles, but they are actually important. They're actually the core foundation, as we have already mentioned, right? So I'll cover you through what it is, why it matters, and how to think about this in practice. So let's talk. Before we dive into that, do you want to take us to the history of how we arrived at these 5 factors? Or?
Yes. So in the history, we're going to start in 1979, and with transfer pricing, hindsight's lovely because you can kind of go back and view things. Often if you're reviewing someone else's position that the environment changed and it did not end up with the results expected, it's very easy to be a critic. And it's also very easy to go back and looking at old versions of the OECD guidelines and think, this is so obvious in today's environment. The multinationals, they're more integrated. There's so many different cross-border transactions compared to 1979. Akhil, I think we would be bored in 1979 with the multinationals, what they do there compared to today, because their business model was very standard. The contracts were very in line with what they were doing back in 1979. When the first OECD guidelines came out, and I think it was called Transfer Pricing in Multinational Enterprises, their main focus at that point was focus was the separate entity approach. Again, going back to the authoritative statement, where that's kind of one of the main principles, breaking down that you do view the different legal entities as separate entities. The other part of this 1979 publication was, what are the different types of intergroup services and how should they be dealt with differently? Which ones are business support? Which ones are stewardship? Which ones are more key operationally? And then the 5 factors were addressed in this 1979 publication, but not together. They were kind of here and there, and as a very rudimentary form. They talked about, the physical characteristics of a product would impact the price, the geography of the product, and they gave a couple examples of business strategies, but they weren't listed as 5, weren't identified, but they're kind of very rudimentary, but it's still very important, but not as it is with today's environment where the multinational is the intellectual property, the digital economies, so much more complexity in the cross-border activities that it has become more important today. So that's why it's in the legislation today in Canada. It's really developed over importance as the business has developed over time. Now, going from 1979 to 1995, that was a big jump. That was a big significant difference. And keep in mind, in 1995, this was just after the U.S. released their extensive transfer pricing regulations. So, Akhil, what can you tell us a bit more about 1995?
Yep, it's for seven. I think in 70s it was more about here is the box, and here is the price, and where it goes. That's where it's going. That's it, right? But I think we didn't had much thing to do when if we were in the 90s. But business got smarter and more global. The rules had to catch up. So that's where in 1995, when the OECD, the commissioners actually understood, and they have actually added 7 new pages into the OECD regulations. It's a full set of regulations of these compatibility factors. These included the institutionalization of the FAR, the logic shifts, and the conduct caveat. So talking about the FAR, it's always the functional analysis where this is when the function analysis, actually the function, risk, and the assets became a mandatory steps in the process of transfer pricing. Then the rule became ambiguous. If you perform more functions or take more risk, it's simple. You are entitled to earn higher return here. And for the first time, I would say that they actually introduced the major warning to these entities, saying that the actual conduct matters. If it's not just the contract, the actual conduct of the parties must match with the written contract. This was actually a huge turning point. Basically, it meant you couldn't just sign a piece of paper and call it a day. No, you have to prove what actually happened. Then came 2010, I guess. Before that, you want to take something up? If any major changes, talk about any major changes with 1995.
Yeah, for 1995, again, you're exactly right. The function analysis now, they call it institutionalized as a mandatory step to do all the activities, and in the one. It did clear a lot of the ambiguity that was in the 79. So, to us, a party performs more functions, assumes more risk, is expected a higher return. That's something that's obvious to us today, but it was a different environment back then. There's other, country jurisdictions having more tax competition, and having that ambiguity cleared up in 1995 is a very key development. The characteristics of the property or services went into much more detail. They talked about tangible goods, the services, and intangible property. Gave a lot more examples into that compared to the previous version. Economic circumstances, a lot more detail. They talked again about the buying power, the negotiating power of suppliers and customers, substitute goods. Business strategies is, I feel, a very key development here. Is that I say there's more empathy in the OECD guidance on business strategies. That they recognize that business strategies are non-exhaustive. That they're changing all the time. Business strategies that we see this month are often are new that I've never seen before. Just as the economy and business changes, as the digital economy changes, there's all different business strategies. So they kind of open the door that yes, the business strategy is non-exhaustive. They gave a lot more examples, and it does have a very strong impact on how the arm's length principle is applied. In 2010, Akhil will talk a bit more about this as well, but 1995 was really where the transaction net margin method, the comparable profit method, exploded into use, because it really tied into the more functions, tying to the compensation, tested party use. But 2010, go ahead, Akhil.
Yeah, 2010. 2010 is then, after all these changes in 2010, when, the hierarchy method, the most appropriate method rule actually came in place. This means you had to pick the most that give the most reliable results based on the actual facts of the case, not just you can pick something. You have to pick something that gave more reliable results. And that led us to the biggest. Then that in 2010 we can't say we aren't seeing much major changes. It's basically the shift of old hierarchy method to the most modern method. Then came the 2015. That's where all the changes, the majority of the changes happened in the OECD. where they're implementing the BEPS project, one of the biggest change in OECD. Then, so this was the value revolution, I would say. Value creation revolution, I would call. The goal was to stop companies from shifting profits place to place. They didn't actually do any work. I mean, they didn't want to shift profits from a place to a place where they don't create any value, so they don't do any work. This is when actually the 5 comparability factors were officially even named as the 5 economically relevant characteristics. That was one of the major changes in 2015. And then comes the 6-step risk framework. They actually introduced a 6-step process to analyze the risk. You have to identify the risk, see who assumes the risk in the contract, and then critically perform a functional analysis to see who actually controls the risk. So this also had a major impact on how transfer pricing worked. Then if the contract says one thing but reality says another thing, the tax authorities have no power to relocate the risk. Tax authorities have the power to relocate the risk, and the price is basically based on the economic reality. It's nothing based on the contract. It's actually based on the economic reality. Then, so do you want to add something to the changes that happened in 2015?
Again, you mentioned this is when they added the label 5 economically relevant characteristics. Before it was known as the 5 factors. So in this presentation, I often say 5 factors, or ERC. I'll refer to that because economically relevant characteristics. Saying that several times is a bit of a tongue twister. But yeah, again, in 2015, the very focus was on risks and what is the financial impact of the risk if those risks were actually occur, to really include into your transfer pricing support, and the differences in risk. How do you, if there's different conditions on the risk, that has a very strong impact. And in 2022, they took the 5 economic relevant characteristics and they really expanded that in the new chapter 10 on financial transactions. So what is the 5 ERCs with respect to intergroup loans, guarantees, cash pooling arrangements, other treasury functions. So that's kind of how that expanded recently in the 2022 version. So that's, again, if you're looking at the history, I find that you really understand more about what the 5 factors are really about, kind of how they evolved and how the multinationals evolved in sync, and why they're so important now. And it's not something that wasn't important in the past, but it's just more relevant in today's economies.
Exactly, and I think that's why we are here. Why we are here going to spend the rest of the video showing how to document each one properly, each 5 comparability factors to be specific, and we'll walk you through the case, some of the major cases that the court have seen. So let's dive into it. The first economically relevant characteristics is the contractual terms. So talking about the contractual terms in simple terms, it's actually a written agreement defines how parties intend to divide responsibilities, risk, and their benefits. In simple terms, it's about who agrees to do what, who is taking care of which risk. That's all about the contractual terms. But they are the starting point of an audit. Actually, Dean had mentioned before. It's one of the topics and the first of the comparability factors that we consider as the foundation, and they define how parties intend to structure their relationship. However, OECD is clear that the contract alone is not enough. The actual conduct that matters more than the written contract. The taxman who follows the conduct, they actually follow the conduct. They don't actually put much into the contract. The contract is pretty much between the parties. Like it's for the parties. It's not for the government. I mean, for the law. To implement this, the companies keep these intercompany agreement as a support contract or a supporting document while transfer pricing documentation is being done. If there is a mismatch, the tax authorities will actually rely on the actual contract rather than what wordings they have added in the contract while submitting the documentation. There are some examples in the OECD too, but before diving into that, Dean, you want to add something to this?
Yeah, no, it's the well, the examples in the OECD guidelines, they kind of do a couple of areas. They talk about risks as well, and they give an example of a limited risk distributor, and certain aspects of the risks are addressed in the contract. You know, they do have risk for inventory and market, and that's one example, but they're not making the key decisions on how to mitigate that risk. That's something that another or a controlled party is doing. They help them manage the inventory, even absorb some losses. So the contract in that example did not reflect reality. So the example there is making sure that the terms of the contract do match with what's going on. Another example they gave is when something's missing. You know, with intercompany legal agreements, you rarely see a contract dispute between related parties going to court, because, you know, often if there's a problem with it, there's something missing, it's amended. So it doesn't necessarily have the same negotiation push and pull that third parties do. And in reality, sometimes key aspects of an intercompany agreement is missing because of you know, inadequate time invested in these intercompany agreements. The one example they gave was marketing. So if you have a company in a certain jurisdiction that is distributing a branded related party product, but they also are responsible for promotion and marketing in their jurisdiction, the example was where that wasn't even addressed in the contract. So who owns that right of the brand if the brand increases, and how's that dealt with? What are the market conditions? And that's going to be different from one company to the next. So again, it's not necessarily being consistent, but also being, making sure that it's complete in all the key aspects. And it's what's complete for you is going to be not going to be complete for someone else, because it all depends on the industry and your business.
Absolutely.
At EP Compass, we do some term sheets for smaller multinationals or small companies that are just, you know, growing. And a term sheet is, it addresses the contractual terms in business language. It really explains what one participant is bringing to the table versus the other entity, and that often serves as a very good precursor to a formal intercompany legal agreement. And depending on the circumstances, that term sheet may continue as a term sheet for a few years if the small multinational is focused on survival instead of necessarily doesn't have the same resources as other larger multinationals. But again, that does serve a very similar purpose in defining what things are done.
Great. So let's talk about the second factor then. If the second factor, or the comparability factor, is the functional analysis, it's often referred to as FAR, or some people spell it out FAR. It's basically the functions, assets, and the risk. The function analysis is considered as the heart of an arm's length principle. The rule is simple: profit should create a value. It means it should follow a value creation. If you do something complex work or use valuable assets like patents, you should actually earn. And the government expects you to earn a higher return. You can't say you're doing all the work, holding all the valuable assets, and your margin is you don't have any profit. You can't state that in that way. It should be it's actually you should be the one who should earn the higher return in this case. So we implement this by interviewing personals and looking up at their organization charts or their process flows, transaction flows. This is where we step back and look at what each entity actually does on a day-to-day basis. Who is performing the key functions, who owns the valuable assets, who is taking the economical significant risk. And this analysis is critical because it helps determine how value is created within the group, and ultimately the profit should align with the value creation.
And this often drives the characterization of certain entities. So if you people that use a responsibility center type of framework, if a company has the scope and responsibility to maximize revenue, then a transfer pricing policy that is linked to revenue, it makes sense. So it really kind of drives the methodology as well, besides just identifying what are the different conditions that you would make adjustments for on the transactions. This is one aspect that really hits a lot of court cases. Just this week, I was reading a summary about an Italian court case on a software distributor where the Italian tax authorities felt that they should be using a profit split method, and I think they called it a transactional profit split method. And the Italian entity was distributing the product, and it was structured to earn a routine distributing return. The tax authority lost the case, and they had the onus to show that the existing methodology was unreasonable, and they lost because of the functions. That the Italian entity was really focused on distribution. It wasn't integrated in the operations of developing the software, the intellectual property that would support a transactional methodology. So you often see this second factor being very strong in a lot of court cases on ensuring that the proper method is used or the proper adjustments are made. The OECD gives a few examples here. They talk about a manufacturer that clearly doesn't own the valuable patents and trademarks, so they should have a routine manufacturing return. So often, this is a case where if you see in the market two competitors in the market, and behind the scenes and kind of underneath that iceberg tip, they have totally different transfer pricing policies. This is maybe because of it. Maybe one of your competitors does own the patents, the trademarks. The second competitor is more of a routine distributor that also gets support, and those valuable trademarks and patents are owned by another jurisdiction. From the market, they might look very similar. Underneath it, they're very different transfer pricing policies because of the functions that they perform.
Absolutely. So talking about the third, the specific nature of being transferred, the property or the service. This includes physical features, quantity, quality, or the intangibles like brand names. Independent parties in the real market place different prices for different quality. You cannot compare a generic product to a high-end branded one, or we can't. Or not all the products or services, they are the same, right? We have to document these using technical specifications, product catalogs and patent details. The quantity, the quality, the uniqueness, reliability, and availability of what being transferred all impacts the pricing.
And that's why that's so important, because it's the differences that make the impact. If you're a distributor, you're a purchaser of watches, and one, all watches, they tell the same time, hopefully, but you got luxury watches, and you got your bubblegum watches that are lower quality, and you have different that characteristics would drive the margins and the volumes and the traits of that transaction. And it's not just when you think about characteristics of products or services. Intellectual property is very big here, and it's often, when you get to disputes, it's often not the actual product or services, but some of the intangibles that are linked to it. A landmark case in Canada, GlaxoSmithKline, is a unique one because the tax authority, they thought they had the smoking gun. They have a comparable price to apply a cup for the raw ingredient of the drug, and when it was chemically identical. So, in the case, maybe there's a little bit of differences, but the effectiveness is identical. Essentially, they're very identical. The generic, what they wanted to use as a generic raw ingredient was a much lower price than the ingredient that is licensed under the contract related to around the IP for the Zantac product. even though it's chemically identical, the court said, no, you can't use the cup solely looking at only the physical traits of the product. So when I talked about the watches earlier, saying, well, two different luxury watches, they're same in the same group. Here, they're identical watches. Here, there's a case where, the product's identical, but it's the generic versus the patented product. And because of the IP around it, the marketing intangibles predominantly, that the court held that, no, it can't look at just the physical product. So again, looking at that dispute, it could have gone, there's a lot of arguments on both sides. And you kind of have sympathy somewhat to the Canadian Tax Authority, because they thought they had the smoking gun. It's exactly chemically identical. But there's more to it. You have to look at all characteristics of the property, the rights, that go around it, even the services. What are some of the guarantees around services that really make a big difference in how they're priced?
Yes, and that's talking about the fourth environment, the economic circumstances. This means where the market is, how big it is, and the level of competition they are having in the market. So market conditions actually affect transfer pricing, right? So if market condition changes, what a company is willing to accept. The distributor in a highly competitive market will naturally have a thinner margin, right? We can't expect a company placed in a market full of their competitors with high competition. We can't expect them to have a higher margin of profit compared to the other entities with a similar market there, right? So that's one thing that matters. We use industrial reports and market research to prove these conditions. This includes factors such as geographical location, market size, competition, regulatory environment, and economic conditions. Actually, all these regulatory environment, economic conditions really affect a company's well-being and the things happening around the company. Even if two factors look similar, differences in the economic circumstances can lead to a very different pricing outcome.
Yeah, and this is a very unique characteristic, this fourth one, and that it overlaps with a lot of the other characteristics. Often, if you're in a certain environment, economic circumstances, that drives the business's strategy, which then drives the transfer pricing. So often, if a new product, new solution, new value proposition that you're have established, there's other competition, you want to get market share, that strategy is really driven by the economic circumstances. Or even going to the functions, what functions are being performed is really driven by what the economic circumstances are. So it's almost like, here's the cards that the multinational is dealt, how are they going to deal with it? And that really impacts the strategy and the pricing. This one also addresses the level of trade. So when I say level of trade, are you selling to the end user? Are you selling to a dealer network? How does that differ? Even though, again, going to the third one, it's identical product, but it's a different level of trade, different economic circumstances, and that has an impact for the transfer pricing. Recently, we've seen a lot of transfer pricing focus on planning around tariffs. And the tariffs, how do we optimize our transfer pricing with respect to increased tariffs? And this factor, the fourth one, is really has a lot of focus on it. So a lot of multinationals have set up a new U.S. operation or expanded their U.S. operation so that when a product is imported into the U.S., it is purchased by the U.S. entity instead of the end user as it was historically. And for tariff planning, they do that so that the price that the U.S. entity is paying is less than it was before. So because the price going into the U.S. is lower, the tariff is lower because the base is lower. But what else is different? What are the differences in the economic circumstances? It's very hard to defend a lower price when you have this historic comparable price unless the economic circumstances are different. So this new U.S. entity, are they doing what value? What are they bringing? that makes sense, that you can show the economic circumstances behind the transaction are different. So that's one area where, yeah, again, a lot of focus and emphasis is important if you want to defend a position where you're trying to minimize your tariff taxes.
Right. Last but not the least one is the business strategy and the comparability factors. This actually looks at a long-term goal like market entry, expansion, or innovations. The strategy, it's basically we are looking at the business strategies of a firm. These strategies explains why a company might lower their profit, or even might accept a lower profit, or even losses if in a short term and in a big win later. We provide these thoughts, broad presentations, market plans, and budget factors. It's like basically we are analyzing why the company is going to accept this loss, or is they going to have a huge win in the future. It's totally futuristic, like what the strategy of a business firm is, how they're planning their future, how they're strategizing their business activities. And there are some examples too for these strategies that have in place.
Yeah, and there's examples of this. There's a legacy example. If you go back to the 1979 publication from the OECD, where they give they have a couple of examples. One was helping out a supplier or a customer that was having some difficulty. The price was adjusted. The other strategy was market penetration, and that's kind of your legacy. We're trying to expand the market. That's why the terms are lower. We're having the loss because we're investing in the long-term benefits of this. Today's strategies as well is a very key, and in the Canadian legislation, there's a lot of impact on there's more focus on ensuring you address industry practices, and industry practices really tie into the business strategies a lot. One recent business strategy that has been advantageous to use for tax planning is from the video game industry. So here's something that is an industry practice in the video game industry, where you have a studio developing a video game. They partner up with a third-party marketing agency, and this third-party marketing agency will accept losses in the short term along with the developer. Now, developers incurring more losses than the marketing agency. They only have certain appetite to share some of the losses. And then when the game is launched, the losses that the marketing agency, they get their losses back first before the game can then start using up their losses. But it's interesting that here is an industry practice that can be tax optimal, because if you are in a startup situation, if you're a multinational, you have one jurisdiction that's doing a routine function. Their only customer is a related party. Maybe they're developing the platform, or they're doing some customer onboarding services. They would be compensated on a cost plus typically, and they would earn a profit while you've got this huge loss in these startup years. So you're paying tax even though your overall loss is large. So here's the strategy that may be effective to apply to have it, to avoid those tax expenses during these startup years. So again, it's this whole area, the business strategy, this is kind of like a Pandora's box to almost sense that it's always different, always changing, and keeping track of the industry practices, knowing what the industry practice is in order to use that to your advantage is key to your transfer pricing practice.
Absolutely. So when we analyze, so in summary, when we're analyzing your pricing, it's important to understand not just what happened, but why it happened. So let's move on to we have few cases actually with transfer pricing. We'll walk you through few cases that we have we think which are most important to be explained. And one of before that, while these 5 characteristics provide a great analytical framework, their practical applications only truly become clear when you see them through real-world disputes. So these court cases that we illustrate how tax authorities and taxpayers actually interpret OECD principles in complex, high-stake commercial situations. They highlight why documenting your intercompany agreements is so vital to ensure your contract aligning with your actual conduct. So the first case I'm gonna walk you through is between Comeco Corporation and the Queen, the uranium giant. So let's start with it. So one of the most significant transfer pricing disputes in the history of Canada is of Cameco. Cameco is a major uranium producer. They set up a Swiss-based subsidiary to purchase uranium for a long-term contract. But when the global uranium prices the setup happened actually when the prices of uranium weren't that high, they were in a lower margin. But when the global uranium prices suddenly skyrocketed, the Swiss actually made a massive profit. This actually triggered the entire transfer pricing policies, and the CRA, the Canada Tax Authority, wasn't happy here. They argued the profit belonged to Canada because the Swiss entity had few employees and limited substances, but the court actually ruled in favor of Cameco. Let's look through why these are related with all our five ERCs, or economically relevant characteristics. Dean, you want to walk through those?
Yes, thank you, Akhil. We chose this one to go through because it has all five economic relevant characteristics addressed in this case, just with the decision and the court case itself. I believe there's a misconception to some extent that this is all the form versus substance type of case, and it's not. When you get into the detail and you look at what was covered on each of the five economic relevant characteristics, number one is very important. Obviously, the contractual terms are very important in this case, but one of the issues that was put is that this contract was a sham, and essentially the Canadian Tax Authority, or the Crown, they really wanted to have Canada step in and take over Swiss roles, because with the higher profit, then that would be attributed to Canada. The courts declined this. They said the contracts were not a sham. They are treating Canada as if they held these, they're not going to treat Canada as if they held the long-term contracts positions for the uranium, but that the Swiss entity, Chemical Switzerland, does have those rights, and the contracts were legitimate. Going to the second factor, the comparability factor, or the economic relevant characteristics, on the functions. There's no debate that Canada has more functions. There's more people, the 2 or 3 people in Switzerland compared to over 1,000 in Canada. There's obviously a very difference in capability and key activities provided on the whole. But when we focus on just that trading agency, that yes, there are functions being provided by Chemical Switzerland, but this is a bit tricky. This could have put the case either ways, because of the degree of support that Canada gave Switzerland. So the Switzerland does need support from Canada, not just from your basic business support services, but other higher valued services were provided as well, such as helping with the negotiation, directing the strategy. They're also looking at managing the risk of the price, the volatility, and giving strategies on how to deal with volatility of the price risk of the uranium. So a lot of key high-valued services were being provided. The court, found, yes, that those were in fact the case. They are getting services provided by Canada, key services, but those should be compensated as service fees, not recharacterize the transaction. So the court case did adjust the terms and conditions, but it didn't change the contractual rights, and still gave legal rights to Chemical Switzerland. But this is one area where you dig into it. There's a lot of key activities being provided by Canada, and this is where people, take the position that if this case was held today, given the new Canadian legislation, some people say, well, it'd definitely be much more difficult for Chemical to win. But this is kind of the second factor would be kind of a key area of where it may make the difference. The third one, on the third factor, that being the characteristics of the property transferred or services provided. Again, it's not just the uranium that they're talking about. an understanding for the comparability analysis, looking at conditions of transactions being controlled or uncontrolled, but is really looking at the contractual rights. That was the main product that they're really examining, the contractual rights to future deliveries under the long-term contracts, not necessarily the products. The services were addressed, but the services are really kind of dealt with on a more straightforward basis that, yes, Canada's providing these valuable services and they should get a fee for that.
Actually. But yeah, and for the fourth one, we have the economic circumstances here. Yeah, actually, the timing was a crucial part here. I've said so because when the contract was signed, the uranium prices were low. The windfall profit happened later due to the market shift that no one could actually predict for sure, right? So this actually gave the Swiss or the chemical a real positive side because this proved the Swiss entity was just parked there with the guaranteed money. They actually took a real gamble. Nobody can argue and win with the statement that they can predict the market about how the uranium prices are going to high in future. But no, they were just parked. They actually took a gamble and they actually won the gamble. That's what happened here when it comes to the economic circumstances. But in the business, and for the last one, the business strategy, Chemical strategy was to centralize its global trading in a specialized hub, the Switzerland market, Switzerland, to manage their price volatility. The court recognized that while the tax was a factor, in planning, the strategy was commercially reasonable for a good player, and in the end, the court actually went in favor with Cameco. Yep.
And one of the key arguments was what is looking at on the controlled transaction, what are the conditions? There's a lot of comparable transactions of other third-party sales agencies that the Switzerland had a lot of comparability with, and would other parties enter into those transactions was one of the enter into that arrangement was kind of the key thing. The minutia was debated. You say, well, would Canada and Switzerland enter those conditions again versus any two parties? So that's the other part of it as well. So it's these five factors are kind of give a lot of the context, and the nature of the case definitely could change with this new legislation and some of the changes that have been made. A couple other cases that we want to address very quickly. You can pick probably any transfer pricing case, and you can find a lot of substance to any of these five factors. The BlackRock case, there's a couple of the factors that are more prevalent. More the second one, the functions. Third one, the characteristics of the property. There, just at a very high level, we have a intergroup loan that the tax authority thought should have had additional contractual protections, such as covenants or guarantee fees. The court found no, the nature and what functions were being provided by the parent and the subsidiary, it was quite evident that those contracts were there, that guarantee was there, and it was embedded into the arrangement that no separate fee was required. Another case, Amazon.com. Akhil, what factor is relevant for more focused on that one?
Yeah, for this final case study, it was between Amazon and the commissioner. Finally, we have the one overall pick from the Amazon case we can take is the characteristics of the property as the economic relevant character that they considered. Amazon transferred certain intangible assets like softwares and brandings to the European subsidiary. The IRS tried to argue that these transfers include future business opportunities and should be valued at a massive premium based on the project future profits. But Amazon actually pushed back. They argued that the transfer should be valued based on the specific identifiable assets that existed at the time of the deal. The court agreed with Amazon. This thought as actually a huge lesson here, right? You must define the characteristics of your property based on the reality today, not on a hypothetical future value. To summarize, these are the five economic characteristics from the foundation of transfer pricing analysis, and the most important takeaway from this is the numbers do not stand on their own. They are simply the results of the underlying economic activities that we have mentioned as an iceberg.
And I find the Amazon one interesting too, because hindsight can blur your judgment. I mean, when you look at hindsight, we talk about the historical versions of the OECD guidelines. Amazon, obviously looking at today, is very successful, and you think, well, having those lenses back in that, like these court cases are often tried in the future from when the transactions occurred. Amazon was very successful with the intellectual property that grew, so it's very. But at that time, there was, they held a lot of risk. It could have gone either way. So it really focused on what happened at that time, what's the characteristics, the conditions to make that assessment, and without hindsight, because often it does. Looking back and thinking of some other cases and say, well, why did it go that way? It should be obvious. Like chemical, you only got 2 people. Looking into the details of all these 5 factors gives you more empathy that, oh, okay, there is more to it. It's not just the top of the iceberg, but there's more substance underneath this iceberg that we need to understand. So to summarize, we do have a booklet with this video. The link is below. That covers everything that we've talked about today. If you want to go through, research there's links to different court cases that we've addressed if you want to dig down in more detail. But this 5 factors is a very key fundamental, and it's something that's very important to understand, to capture in your transfer pricing practice, because it does have such ramifications, and it opens up a lot of opportunities by going through and making sure that you have these 5 factors. So as one exercise is to, looking at your transfer pricing support, can you spot each of these 5 factors where it's addressed in your supporting documentation? And if there's gaps, there may be exposures, or there may be opportunities for you. Thank you very much.